Today, we're here to talk about an exciting, powerful tool in the retirement planning space. One of the most powerful tools out there, and it's for independent contractors, consultants, real estate professionals, small business owners that don't have employees, and it's the solo 401k. And I'm here today with a longtime associate specialist and friend, Mark Frydman, who's a retirement plan administrator. And welcome, Mark, and thanks for coming.
Thank you, Adam. It's my pleasure to be with you.
Yeah, appreciate it. So the solo 401k, we've had lots of talks about this over the years. And, first of all, Mark, like in your explanation in simple terms, what is a solo 401k?
That's a great question to start. So a solo 401k in its simplest form is a retirement plan that has no employees. So it can primarily cover a business owner, or if there's more than one business owner, let's say there's two partners, 50-50, that would qualify for a solo. If a spouse of an owner is part of the employee group, that would also allow it to qualify as what's called a solo. Now, there's actually no technical word for solo 401k plans in the law. Think of them as single participant or single participant plans, or if there's multiple participants, they're only comprised of business owners and or spouses. And the moniker solo implies a couple of different things. It has a different set of rules, not completely different, but there are a subset of rules that are different that apply to plans that meet the solo definition that don't apply to qualified plans that have employees. So, for example, a solo 401k plan does not have to file any sort of tax return until the assets of the plan are $250,000. Very often, when plans are put in of that nature, because you don't need a tax return, employers don't hire an outside firm to do the administration on the plan. So there's a different set of rules and a different approach and mentality that occurs with a solo. But anyway, that's the definition of a solo. So it's simply a plan that has no employees.
Okay. Well, thank you there. And we'll go into these a little bit more, some of the aspects as we go. But Mark, let's go back a little bit more. Like, as far as who qualifies, you mentioned, business owners that don't have employees, or a partnership where there's two 50-50 owners.
As an example, it could be 33 and a third.
Okay.
As long as it's all business owners.
Okay, great. And then you mentioned spouses. So
yes.
how do the spouses come into the mix on these?
The spouses simply come into the mix that they may not be an owner of the business, but they work with the owner.
Okay.
And therefore, they can certainly be a part of the plan, and very often are. And the same requirements, the requirements for tax filings do not change because the spouse is part of it.
Perfect. Well, that's great. So let's talk about, I guess, like how much money, maybe let's talk a little bit about how much money can you put in a solo 401k. I think there's a lot of confusion around this.
Again, another good question in terms of how much money. So a solo 401k has the same IRS limits as a 401k or a profit sharing or even a defined benefit plan, for example. So you may be able to put in a 401k deferral. In 2026, the 401k deferral limit is $24,500. If you're at least 50 years old, There are catch-up contributions available. This year, the catch-up is $8,000. So for somebody who's 52 years old, they can put in a 401k deferral of $24,500, and they could also make a catch-up of $8,000.
Great.
If they so choose. There is something called a super catch-up, and this applies to all 401k plans, including solos, when you're 60 to 63. And this is relatively new, Adam, but it's very interesting. I don't know how the IRS picks 60 to 63, but at 60 to 63, you can make a super catch-up contribution, which is 150% of the normal catch-up.
So instead of the 8, it becomes 12.
Right. Now, actually, there's a look-back period, but it would be 12. This year, it works out to be 11,250. But putting aside the limit, just people should be aware that the super catch-up is available.
Okay. And what about, where does the 72,000 come in?
So the 72,000 is a limit that applies to all 401k plans. And that is the overall limit that encompasses aggregating 401k salary deferrals with employer contributions. So for example, if an individual puts in the 24/5 as a 401k salary deferral,
mm-hmm.
They can also make additional discretionary contributions. They're also known as profit sharing. It can be in the form of an employer match. Candidly, I don't think it matters which one it is. The profit sharing may work better if there's a partner involved. But so you can fund up to $72,000 by making an additional employer contribution on top of the 401k salary deferral. So if you do the math, and if you're dealing with an individual who wants to maximize the amounts going into the plan, the maximum would be $72,000. They fund 24/5. So that, if my math is correct, that leaves a gap of $47,500.
Mm-hmm.
You can make a profit-sharing contribution, also known as a discretionary contribution. It's optional, up to the $47,500. Now, IRS prescribes a deduction limit for that $47,500. You can contribute and deduct up to 25% of your compensation. And I'll mention what compensation means in a second. So, moving over to the math model, with a 25% deduction limit, and you want to fund $47,500 because your end game is to maximize it, you would need $190,000. 25% of 190 is $47,500. You'd need $190,000 of compensation to maximize that 401k.
Okay.
Now, compensation for business entities that are incorporated, whether it's an S Corp or a C Corp, is W-2 compensation. So if somebody's an S Corp and they're also taking a shareholder distribution, even if it's substantial, it does not count.
Good point.
So you could have a person who's making it up, $500,000, but they may be taking $80,000 of W-2, and the balance is a shareholder distribution. We're limited to the $80,000 when we're calculating these deductions.
And what other common types of income don't count towards these retirement plan contributions?
Well, if it's not income subject to self-employment tax, it's not going to count. And my reference to income subject to self-employment tax is a term common to self-employed or unincorporated businesses because they do not provide a W-2.
Mm-hmm.
But they are still going to pay FICA on some amount after the accounting is done. And it's the income subject to self-employment tax that'll be relevant. When we do our work on clients who are unincorporated, we want to see the client's net Schedule C income and their income subject to self-employment tax, because there are unique calculations that are done for self-employed individuals. But in the end, the income that will count is the income subject to self-employment tax.
Mark, the way I think of it, and tell me if I have this right, is if you're if you're unincorporated, like a sole proprietor or
Mhm.
partnership, then it's what you're paying self-employment tax on, that net self-employment. Or if you're incorporated like an S or a C corporation, it's whatever the payroll amount is.
W-2.
W-2,
Yes.
right? Okay. Great. But capital gains does not count.
Absolutely not.
Royalties or, whether it's short term or long term, like any of that, or distributions from the company does not count. Okay.
Correct.
Good. Great. And then, and now what if that 72,000, that's with the salary deferral and the profit sharing contribution. And what I would also, just to clarify, if they have a catch up, like they're over 50, then it goes up from the 72. Is that correct?
Once they attain age 50, they have the additional catch-up available, which is $8,000 currently. So that moves that 72 to 80.
Perfect.
One comment about the catch-up,
Mm-hmm.
and we haven't touched on this yet, but I suspect we'll get there. But a catch-up must be a Roth if you earn a certain compensation threshold in the prior year. So when it comes to, and if I'm going to jump ahead, just tell me if it's okay.
Go ahead.
The solo 401k plans probably has more uniqueness and flexibility than the typical qualified plan, because all IRS rules that apply to normal 401k plans or plans that have employees, there are discrimination rules that apply. But in a 401k that has no employees, there cannot be discrimination because the IRS, I won't say doesn't care, but you're not being subject to the same compliance testing because there's no employees. So when in a solo 401k plan, there's a lot of unique opportunities that don't necessarily easily exist in regular 401k plans that have employees. So the solo allows you to contribute 401k. It's pretty standard in a 401k world across the board. And that 401k can be pre-tax or Roth. Or it could be a combination of the two. So for individuals who are doing financial planning with their advisors, like yourself,
Mm-hmm.
It's a good conversation because you have the opportunity to make after-tax, which is what Roth is, an after-tax contribution, or you can make it pre-tax. The profit sharing can be pre-tax, but it also can be designated as Roth as well.
Oh, interesting.
And we haven't even gotten into the so-called mega backdoor Roth, which is a very common technique in solo 401k plans. But when it comes to financial planning and options inside a solo 401k plan, the ability to make pre-tax and or Roth or both is a very effective planning tool, particularly for somebody who may be younger, because the Roth can be advantageous for younger people. Although these days, candidly, I'm seeing much older people making Roth 401k.
Yep, it's a big topic.
Or after-tax contributions. So it offers unique flexibilities that are very valuable from a financial planning perspective.
Sure.
So you could have a scenario where the solo 401k owner makes a Roth contribution, for example, on the 401k side, and then makes a profit-sharing contribution, also known as a discretionary contribution, on the employer side. The employer contribution goes in pre-tax. The employer takes the tax deduction. The amount goes in and grows tax deferred. So hence, that portion of it is tax deferred until it ultimately comes out of the plan. The Roth, of course, goes in after tax rather.
Sure.
And the earnings, when you ultimately take them out, and the basis, the actual Roth contribution, all come out tax-free.
So, and then if somebody is making good money, I really like these for, especially the high income earners that really want to put money away. And so if they do have a spouse, then they can potentially double that. So
Absolutely.
yeah,
So the spouse can also fund a full 401k salary deferral. Now, not to be obvious, but you need enough compensation to defer.
sure.
So compensation does matter. And
Mhm.
often that's one of the first questions we ask is, what are you earning? What are you taking?
Yep.
Because that helps approach design and strategies. And, the amounts I'm giving you, the 24.5 and the profit sharing of 47.5 to hit the maximums, those are the upside. Not everybody funds at that level.
Sure.
It's all discretionary. It can be lower, but and it's all discretionary. Just can't be higher and it can't exceed them.
That's one of the things I really like too. I mean, you and I both love the defined benefit or the cash balance world, but at the same time, one of the flexible aspects, as you mentioned, with these 401k plans is put the money in if you can afford to, if you want to, if you're motivated to do so, whether it's for tax benefits now or tax benefits later, like the Roth portion. But if business slows down or things come up, or you got to put all your money towards, buying a house or something, you can kind of take that back or
Absolutely.
lower it, so to speak.
Absolutely. Yeah. And, any small business owner, and obviously when you're dealing with a business that is just a business owner and maybe a spouse or a partner and no employees, conditions change for every business from year to year, but certainly when you're smaller, things can change, and everybody appreciates flexibility.
Yeah. So one of the things that is near and dear to my heart, which is one of the reasons one of the topics I really wanted you to talk about, because I've seen it over the years multiple times where people get drawn into these free plans, right? Where all the big firms offer like a free solo 401k, Schwab and Fidelity and all the like. We all know the major firms there. But there's some drawbacks and things that don't get attended to, right? So I wanted you to maybe from an administrator perspective, maybe share some of the stories that you've seen or some of the drawbacks of those free plans.
Yeah. And, that's an interesting topic and comment, Adam. Being in the retirement plan administration and compliance side of the business, often I can certainly speak to the benefits, and there are many, but I see the underbelly of compliance as well. And in the retirement plan world, the underbelly of compliance often means when you do something wrong, it will cost you money. It will cost you, the employer, money to fix it. So there are a few pitfalls that I have observed over the years that just seem to consistently rear their head. And we will often take over a solo 401k, and have to make fixes to it. And so I can address some of them. The big companies, some of which you've mentioned, they offer various services to encourage asset growth at that company. So they will offer a solo product, if you will, and give you a free plan document and allow you to fill out that document and set up the plan with them and set up an account and start funding. Now, in a plan that has employees, there's much compliance work. So very often, actually almost universally, that company will hire a firm like ours to do the annual compliance testing, work, IRS reporting, et cetera. But In a solo 401k, you don't have any tax reporting until you hit the $250,000 asset threshold, which I mentioned earlier. And you have financial institutions that will give you free plan documents. So what ends up happening that I've observed is a few different things. Number one, many people don't fill out the plan documents correctly because they've not hired a professional.
Mm-hmm.
Maybe they'll lean on their financial planner or their CPA to help them. But even in those circumstances, those people, unless they have unique knowledge, don't understand the implications of checking boxes and options inside a retirement plan document that may or may not come back to haunt them years down the road. So that's part one. Part two is just the annual calculations of contributions. Who is doing it? Is it the CPA? Is it the client? Is it the financial advisor? Is it their brother? Do they know the limits? Do they know what the compensation definition is in the plan?
Is it correct?
Are they calculating it correctly? Do they know there's a compensation limit? I could tell you war stories. And I'll tell you a very quick, simple faux pas. I came across a client who called me up. He didn't turn into a client, but he was a prospect, but he had a problem. Somebody told him they thought he was funding too much into his solo 401k. Turns out that deduction limit of 25% that I mentioned earlier, he was calculating his discretionary based on a 25% deduction limit, but he earned $500,000. 25% of $500,000 is $125,000. He put in too much into his plan. He did this 5 years in a row. So point is, unless there are people around the plan who understand the terms, understand the calculations, know the rules, there are errors that can occur in the period that the solo 401k plan is operating by itself. Now, if you set up a plan at a Fidelity or a Schwab, for example, but you're not hiring them or an independent party to oversee the administration and calculations, you can run into these problems. Another problem that I have seen very commonly, and this is a really, candidly, this might be the worst one, is, as I mentioned earlier, I have observed plan documents are not filled out correctly. Or they don't understand what they're doing when they're filling it out because the people filling it out are not pension professionals. Now, when we put in a new plan, we prepare the document, we discuss the terms and the options in the plan with the client, review it with them, they're sent a document and they sign off on it. A very common thing I see with solo is no eligibility requirements are put into the plan. Now, on day one, that business owner sitting across from whomever at Schwab may think, well, I'm not going to hire any employees. It's just me. I don't need an eligibility requirement.
Then they hire someone.
Then, and it could be something as innocent as they hire summer help.
Yeah.
And they pay them a W-2. With no eligibility requirements, that person could even be 16 years old or 17 because there's no age or service requirement. But whatever the example is, even if it's something as innocent as summer help, the second you put that person on payroll, they met the eligibility requirements. And if you did not enroll them into the plan, you have now created a compliance problem. And that compliance problem is pretty deep because now you have an employee. You're no longer considered a quote unquote solo, and there are now compliance requirements that must be met. The 401k deferrals that you put into the plan are now going to be subject to a 401k test. You never even enrolled that participant. They didn't put in anything. And you have now failed your 401k test, and most of that 401k has to come back as taxable.
Hmm.
You also have to make a contribution for that employee for the lost opportunity. And there may be other requirements that kick in. I won't get into the details because there are other technicalities. But basically, that innocent wrong checkbox in a plan document and the innocent hiring 2 years later of even something like summer help, you just blew up and create your 401k plan for that year. And for all the years that situation existed.
Another one that I've seen is somebody maybe truly had a solo 401k, but then they ended up becoming a partner in another business. Then all of a sudden there's they own 50% of another business that does have employees, and that's yeah. So if we just maybe summarize, like, what are some of the things that you do not get with a free plan that doesn't have administration?
Well, you get potential problems that you have to solve when you ultimately need to hire somebody. Now, typically, people start to bring in a professional when they hit the $250,000 threshold, which is when you are required to start filing tax returns with the government. So it could be 2, 3, 4 years down the road before that happens. And during that whole period, the plan is going unattended. The client may be funding it, probably is. The money's invested at the institution, but nobody's monitoring the plan. It's tantamount to trying to do your own tax returns every year when you're running a business.
Yeah.
Until you think you're big enough or complicated enough that you need to hire a CPA. We're the CPAs of the 401k world.
Sure.
And, you know, when I see a client coming in, it's very often I'll get a call and say, hey, Mark, our client hit $250,000. They need to start filing a tax return. And in my mind, I'm thinking, okay, I have to collect all this information now to see if they've done things right. Because you don't want the client to be in a position where they're audited and don't know they have problems. So the very first thing I look at is, do I have a signed plan document? If you don't have you'd be amazed how many people don't have signed plan documents. If you don't have a signed plan document, you don't have a plan. And you've been funding it all along. Second thing is, what does the document say? The third thing will be, where are the assets, and have somebody been tracking the money sources inside the assets? So, for example, as we discussed earlier, in a solo, you can fund pre-tax or Roth as 401k. You could fund additional discretionary employer contributions. And if you've been, as an example, if you've been funding Roth and employer profit sharing, one is tax deferred, one's after tax.
Those have to be treated as different accounting buckets, right?
Absolutely, because it has different tax consequences, different money sources. Very often, the solo is set up with one brokerage account. Now, that's okay as long as you're tracking it. So when I'm looking at a prospect coming in who's had a solo, very often I'll ask, has somebody been tracking it? The answer is always no. Because they're not aware they even have to track it. It's not on their radar screen. So we end up having to collect data back to day one to source the money so that we can start moving forward. If the solo is old enough, the plan document itself, which is subject to regular IRS regulatory updates, if they don't have proper updates, they're out of compliance.
Well, I do know. I wrote down just a few, and you've touched on some, but maybe just in summary, because I don't want to make it like a doomsday thing, but I did want to kind of give a sense of some of the issues. But the typically the free plans for solo 401ks, They don't include plan design, compliance support, documentation updates, Roth features, after-tax features, loan provisions, or corrective actions. Would you say that summarizes it?
Well, I would say more than likely the financial institution will provide some sort of cheat sheet and say, this is how you do it, and then put it in the client's lap.
Yeah.
So it may or may not include those provisions because somebody has to complete the plan document. And for example, Fidelity or Schwab will not complete the plan document for you. So all of those things are possible.
Yeah.
And anything goes when it's in the hands of a person who's not equipped. It's not their business.
Yeah.
That's why I encourage, very often I encourage people to hire a firm, I'll say like ours, to oversee it from day one. And there may be people who whisper in the air, you don't need to hire an independent professional. You don't need to spend the money. When you hit a tax return filing, then you should do it. But candidly, the problems that I've seen, to my way of thinking, it's just good insurance to do that. I view it as insurance, not anything else, because when you do hit those issues, it'll end up costing more money than what you've paid. But putting all of that aside, those are the things I see that occur on a daily basis in the real world. But when they're set up correctly and they're operating correctly, they have incredible flexibility and incredible value from a tax planning perspective. The Roth inside a 401k, which many people are aware, but maybe not everybody is, when you don't have a 401k, there are income thresholds to fund a Roth IRA, where basically you're shut out of it, because if you're lucky enough that your income is too high, you are now shut out of a Roth IRA.
That's a great point.
And inside a 401k plan, it does not exist.
That is a fantastic point.
There are no income thresholds. So you could earn $1 million. God bless you if you do. But you could also max fund a Roth. And there are no income thresholds. You don't have to, and the limits are much higher in a 401k than an IRA anyway.
Absolutely. I'm glad you brought that up. So let's jump into the mega backdoor Roth IRA or the 401k Roth IRA. Let's just kind of paint a picture, from a high level, like what is that? And I know we kind of touched on it, but maybe, yeah.
So mega backdoor Roth is a term that is floating around the internet, and it's a very interesting device, and it's another lever that you could pull inside very easily inside a 401k plan that is a solo 401k plan. So there are different money sources that can go into a plan. Number one, salary deferral is one. 401k salary deferral, pre-tax or Roth. Employer contribution, whether it be discretionary or match, is number two. But there's another money source that has always been in the law, not necessarily very utilized for various reasons, but it's called an after-tax voluntary contribution. So it's similar to the Roth in nature. It's after tax, and you can fund it up to the $72,000 limit. But you don't see it very often because, number one, an individual has to have that discretionary income to make contributions. A plan that has employees, where a business owner may want to make after-tax voluntary contributions, if a plan has employees, it's going to be subject to compliance testing. And to oversimplify it, employees will need to make after-tax voluntary to allow the business owner to do it. So very often in the small employer world that has employees, it's not going to work because you'll never pass the test. When there are no employees in the plan, and like in a solo, there's no testing. So that option is available. And it begs the question, okay, if it's after-tax voluntary, what's the difference between that and Roth? And the answer is there's very little difference, if any, because they're both after tax. But when you make a Roth, and that has a very specific definition, the earnings come out tax-free. With after-tax voluntary, the earnings do not come out tax-free. They can be tax-deferred. And you know what? You could leave it like that. But if you want it all to be Roth, when you reach retirement, you have to do some sort of conversion.
Annually, or right after you make the contribution.
Right, exactly.
Right? Yep.
So let me paint you an example. An individual makes a 401k salary deferral. Now, let me preface before I continue. This is for somebody who wants everything to come out tax-free.
Sure.
So an individual makes a Roth 401k of 24.5. They're 50 or older, they get a kicker. So 24.5 goes in. Now you can fund up to 72,000 in the defined contribution limit. The difference is 47.5. You can drop another 47.5 in as an after-tax voluntary to hit the 72,000. And then at that point, either transfer it, do an in-plan transfer to a Roth account, or transfer it to a Roth IRA. Now, there's paperwork, there are mechanics involved, but it is, I'll say it's as simple as that. You now...
It's a form, right?
It's paperwork.
Yeah.
Your plan documents, your adoption agreements, have to have certain provisions in them to allow this to happen as well.
Mm-hmm.
We take care of that to make sure it can happen. And again, that's where the off-the-shelf documents, if people want to do it, either you have to know what you're doing or you're doing it wrong. But the beauty of it is if your strategy is to have money come out tax-free and you're willing to pay the taxes now, you could have $72,000 for that year all be Roth by doing that conversion. There's another really interesting part to this, Adam. When you contribute 24.5 and you want to maximize the balance by making an additional $47,500 contribution, when you make it as a discretionary contribution and you want to take a deduction for it, you need $190,000 of compensation to hit the 25% deduction limit. With an after-tax voluntary, there's no deduction limit because there's no deductions. It's all after tax. You don't need $190,000 of W-2 to hit that $72,000. You know what you need?
72?
$72,000. If you have $72,000 of W-2 and you have the money to put away on an after-tax basis, you could literally make $72,000 once you get through the Roth conversion on the after-tax voluntary. You could have $72,000 of W-2 and $72,000 going in to a solo K, all coming out tax-free when you reach retirement.
It's a powerful tool right there.
Let me one-up it for you. Let's say you do want tax. Let's say you're just one of those people who just does very well, and you still want tax deductions. You can couple a 401k with a defined benefit plan. Now, this is for people, and you have to be the right age. You have to have the right compensation. It will, I'll say it'll complicate it, but you'd only complicate it with good reason.
Yeah.
But if I'm making this up, but let's say you're a 52-year-old. You fund $24,500 as Roth. You make an after-tax voluntary contribution. And there may be limitations if you add a defined benefit plan on that after-tax voluntary, but it still won't dilute the solo K much at all. But you're still doing very well, and you want pre-tax contributions because you do want to reduce your tax liability and you want to continue to accumulate retirement savings. You could add a pension plan, also known as a defined benefit plan, on top of your 401k. And if you're the right age and have the right compensation, you could fund $150,000 in pre-tax money as employer contributions as well. And For those folks who don't know what the tax rates are going to be when they reach retirement, we could all guess. Some people think rates will go up. Some people will say they'll go down. But you'll have hedges built into your retirement plan portfolio because some will be after tax, some will be pre-tax.
And I love the whole concept of tax diversification, to have a bucket of money that is tax-free and a bucket of money that is tax deferred that you saved taxes on each year. So that's powerful.
Right.
And yeah, the ability to mix and match this and do, tax deferred, salary deferral, and then also do the voluntary. I mean, really it creates some interesting opportunities in the planning space. And one of the other aspects that I maybe just touch on is there's some with any kind of retirement plan, Mark, the money that you have in these retirement plans, they're protected from a lot of other people, like, lawsuits and whatnot. Can you touch on that a little bit?
I'll touch on it. I'm not an attorney, but I can tell you that plans that are subject to ERISA, the Employee Retirement Income Security Act of 1974, are deemed protected. But they have to have they do have employees. So but a plan that is ERISA protected or an ERISA plan more specifically may not be subject to lawsuits, bankruptcy, et cetera. A very famous or infamous person was O.J. Simpson, who lost in civil court, of course, as the world knows, owed a lot of money, but he was able to keep his NFL pension. And so pensions can be protected as long as as an ERISA plan. A solo plan, because it doesn't have employees, is not considered an ERISA plan.
Okay. I'm glad you brought that up.
So it may not have, again, people should talk to their attorney, but it may not have that kind of protection.
Okay, great. So one of the things that I wanted to mention is if somebody wants to add like the pension or the cash balance later, is that a conversation that can be visited over time?
Absolutely.
Okay. And same as if they do buy other businesses or add employees, that's something that they can,
anytime you add an employee or are contemplating adding an employee, or if you are buying into another business and own it, and the percentages will matter and the operational relationship between the two businesses will matter. But retirement plan, just to talk from a high level, if you just own a single business and it's just you, no problem.
Okay.
If you're married and your spouse owns a business, it may not be something to address, but it is something that can impact the plan. But when you own multiple businesses, when you have ownership in multiple businesses, there are compliance rules in the retirement plan world that absolutely have to be looked at and addressed to make sure that you're covering the right amount of people. Or if you already have a retirement plan and you buy into a business, it's relevant to know if that purchase or buying into another business will affect the operation of your current retirement plan. It's a very normal and important conversation that doesn't always get held, but can affect the operation and the design of the plans.
Okay.
Plans can be amended going forward. So if you did need to change something as a result of an acquisition or as a result of hiring an employee, it's easily done. The problem is when you don't know about it. When you do know about it, then it can be addressed.
So we talked about, the ways that somebody can benefit or avoid mistakes by having an administrator to the plan. And I know prices change and you can be general with this, but I mean, what does that typically cost on a yearly basis?
Sure. And obviously I'm just speaking from our entity.
Sure.
But if we were to set up a solo 401k plan, for example, we would charge a one-time fee of $500. And that will include any plan design, going through the plan document, installing the plan on our systems, and making sure we track everything. And we would sit down with the employer, or maybe do it via Zoom or Teams, but we would go through the plan provisions with them, make sure they understand it, and of course, design plans to protect them. So I mentioned before, a very common thing is no eligibility requirement. Well, we put eligibility requirements into our plans. The employer has to meet them himself, of course, but we will make sure that we're putting an eligibility requirement in. So in the event that they do hire somebody and, we don't find out about it for 6 months or a year, it still hasn't affected the operation of the plan. And that's an important thing. So one-time fee of $500, it involves all of the upfront design and information. And then to monitor the plan and calculate contributions each year, we'll charge roughly $650. There may be some additional charges to do asset accounting, and it's all our fees. Our fees are tax deductible. Once they hit the $250,000 and we have a different set of requirements, that fee will go up to roughly $950.
Seems reasonable to me.
I've always thought so, but if somebody is whispering in somebody's ear like you don't need them, it's not that complicated.
Yeah.
I've heard it all.
Yeah.
But like I said, to my way of thinking, it's simply insurance.
Yeah.
You pay insurance to protect yourself against things that you don't know can happen.
Sure.
And that's all I view it as, that until they hit the tax filing threshold.
So I want to maybe bring up one last thing,
Sure.
which is a case study that I just did some simple math, using financial calculator, which
Okay.
is and I want to bring up a point, but assuming today's limit stayed the same for the next 20 years, so that's the 72,000. So someone who does a solo plan puts in the 24/5 pre-tax. So they wanted to save some taxes, but then they used the 47/5 in the voluntary, which is like the Roth, the after-tax bucket. And then they earned 8% average return, which may be a conservative or a moderate investor return over 20 years. Just the math on that is pretty powerful.
I'm sure.
And I'm gonna ask you to affirm a point that I wanted to make. So what that means is there'd be two buckets of money at the end, which would be the tax deferred bucket of 1.1. Just call it 1.1 million. The after tax bucket of 2.1, for a total of almost $3.3 million, but the contributions were really only about 1.4 total. The thing that I wanted to mention or bring up here is that there's a huge difference in this growth of that after tax bucket, that unless there's an actual in-plan conversion to the Roth, or we convert to the Roth each year for those contributions, that there would be some major planning miss or that would become taxable on that after-tax bucket. Is that correct?
If I understand you correctly, certainly if you don't convert the pre-tax to Roth, when the money ultimately does come out, you're going to be paying income taxes on it.
On the gain. Is it on the gain?
It will be on it'll be on the whole pre-tax account.
Okay. Oh, pre-tax.
Pre-tax.
Yep, thank you. Yep.
On the Roth account, you're not going to pay any taxes on it.
If it was converted.
if it either went in as in your instance, it didn't, as long as it was converted.
Yes. Okay.
Yes.
And when I was looking at that, there was potential for several $100,000 of gain on the after tax that could be taxed or not taxed, depending on whether those conversions actually took place.
Yeah. And if you're making the after tax voluntary and going that route, you're absolutely going to want to take that next step and convert it at the point in time you make it, so that bucket comes out all tax-free.
Thank you. So just in final, just to kind of wrap this topic up, is what would you, any other points you would add or that I didn't bring up about the solo plans or using an administrator for these?
Yeah, no, I mean, we touched on a lot, but clearly there are very interesting nuances. A lot of successful people, high wage earners, they want the pre-tax contributions now. And that's understandable. You want to reduce your current tax liability. And properly so. Many people feel, if I don't have to pay taxes today, I don't want to. But if you're not paying it today and you're setting up retirement plans and taking the deductions, at some point you're going to pay the taxes. So it's a very interesting analysis. None of us can predict tax rates. But the planning that goes around it often involves a CPA, a financial advisor, and a firm like ours to go through all the different options. It's a three-legged stool, and each person has their own piece. We can design a plan from a compliance and operational perspective and do our best to keep clients out of trouble and to meet their goals. The financial advisor often is the orchestrator, the quarterback, if you will, to coordinate the different parts, and the CPA, and of course the investment of the funds. And the CPA comes at it from a tax perspective. What makes sense today? How can, what might your situation be 20 years from now? So there's different parts and pieces that go into good decision-making. Having the right professionals, retirement plan consultant, financial advisor, CPA, critical for any client.
Beautiful. Thank you for reinforcing that point. And thank you so much, Mark, for being a trusted colleague, ally, professional specialist over the years. And thanks for spending some time with me today to share this information.
It's my pleasure talking with you, Adam.
Thank you.
Obviously, we know each other a long time. I know how good you are at what you do, and I appreciate it.
Thank you. All right.